Hello my fellow freedom builders and welcome back to the channel. Now today's video is about the entire market and as to if it is overvalued. And I know I have made videos about that, and every single time I make a video like that I get a lot of comments saying, oh no, the market is not overvalued, I am just a pessimist and I should not go around and predicting market crashes. Well, I am not. I'm not predicting market crashes, and what I'm going to show you today is some research that shows that the QE packages, the quantitative easings, have been a part of pumping the market up. Now, I'm not predicting when a market crash will come. I do, however, predict that it will come somewhere within the next 100 years, and it will be somewhere between -1% and -100%. That is my prediction. And I am pretty certain that no one can make it more precise, because no one knows when a market crash will come. They can guess, they can estimate, but what I'm going to show you today is some fact. I'm not predicting, I'm not saying when it's going to happen. I'm simply saying that there are some factors in the market that is pumping up the stock market value without the real economy really following. Now this can go on for decades, so you may be well off in your portfolio and should not be worried about some crash risk. I, for my own portfolio, have actually bought a couple of stocks today, and that is just to tell you that I do not see a crash coming anywhere soon, and if it comes, I simply sell as I did in the spring. So that said, let's go to the research, and remember to subscribe to the channel, and also press the link below to the website buildingfreedom.dk, where you can put in your email and you get on my email and mailing list so that you get all the news here from my little site here. All right, let's get straight to it. You know, if you have seen my videos before, that I sometimes have said that I am using this Warren Buffett indicator. That is simply an indicator showing how fast the stock market is growing and how fast the overall economy is growing. And as you can see here, the blue line is what is called the Wilshire total market cap here of something like $36.5 trillion. And we can see the overall GDP also growing, but not growing as quickly. And the overall theory is that when the overall stock market is way higher than the GDP growth here, then we are at least somewhat overextended. But as you can see, this can go on for years, and people could have started saying that we had an overvalued market back in 2013, and if they had stayed out of the market just for the fear of the market being overvalued, they would have simply been out of the market in this huge bull run. So I'm not urging you to stay out of the market, not at all. But what we are going to look at today is from an article here from Market Watch, and I will link to it below so you can see it for yourself. But they have a headline here saying how much of the stock market's rise over the last 11 years is due to QE. And QE, the quantitative easing, is this thing. The central banks have done it for years, but especially after the financial crisis in 2008, they really started doing it big time, and that is pretty much where the central banks are printing some money, buying up some bonds to keep the interest rates in the economy, in the society, quite low. So what Societe General, I think it is pronounced here, what they have calculated is, if we just scroll a bit down here, we'll look at the first part a bit later. But what they have done is that they have been trying to build a model over some, as I said here, a mix of weekly macroeconomic indicators running back to 2005, to try to build a model that could predict where the interest yield would be, meaning the percentage yield you get from the 10-year bonds. And as you can see, the gray line here going up and down like a jigsaw here is actually the real yield. then they have their model, and their model with the macroeconomic data put in is this greenish brown line here, and you can see that it actually correlates quite nicely with the actual overall yield here. Now, the red line is the model without the quantitative easings, meaning that is the yield that would have been in society if it had not been for the central bank, for the Federal Reserve, buying up a lot of bonds to their balance sheet simply to keep the interest rates low. So as you can see here, the 10-year yield is actually down around 3%, but would have been up at around between 3 and 3.5% here for the last couple of years if it had not been for these quantitative easings. So what they have done next is they have tried to estimate how much, and remember this is just estimates, but they have tried to figure out how much of the different stock indices have actually, how much have they been affected by this lower interest. And they are looking at a lot of different variables, and of course this is not 100% certain. But I can say that from my point of view, they are quite spot on. Now, I don't know about the exact percentages, but I've been talking about in many of my videos that I think this money printing from the Federal Reserve has gone completely mad. It has gone berserk, it has gone parabolic, there is no end to it, and I don't see how they can step back and start to move this backwards. We saw in 2018, where it has been a fine stock year up until Q4, and then the Federal Reserve, the Fed, they started to say that they had started to increase the interest rates, and by doing that they simply created a stock market crash of 20% over Q4 in 2018, and then by a new year, between 18 and 19, they said, oh yeah, well, we might actually lower the interest rates again, and the stock market shot straight up from there. So I've been talking about in many of my videos how I think the Federal Reserve is the main factor that is actually moving the overall lines in the market. And what you can see here is they found a lot of variations among the different stock indices, with the tech concentrated Nasdaq 100 feeling the most impact from the QE, particularly in 2020, while S&P 600 small caps were the least affected. And what they're saying is that from back from 05, where they actually took the data, but again from the when they started the QE in 2009 here, you can see that the part of the rise in the different stock indices is that we have the S&P 600 small cap. You could say that, or they are estimating that 24% of the entire increase in the small cap index comes directly from the QE packages. I'll return to in a second why that is, but you can see the mid caps has that is 34% of their increase in stock movement here. That comes from the QE help. The S&P 500, we can see that 44% of the entire stock movement from back here, from 08, 09, that is due to the QE packages, and the Nasdaq 100, the tech stocks, is almost 60% of the stock movement here. Now, there are different reasons for that, and that is, of course, the overall stock market tends to go up when the bond yields go down. That is, of course, if you have heard the term TINA, and that is short for there is no alternative. This TINA concept means that when the interest rates are down here around 0 to 1%, then every fund, every stock investor, they don't want their money just to be sitting in a bank at almost 0%. So they are pouring the money into the stock market, helping the stocks to run up. There's also another thing, and that is, of course, that the companies, they have an easier time growing their business with lower interest rates, meaning that if they want to build a new factory or they want to do a lot of research development and so on, they can simply borrow $1 billion to grow their business and pay almost no interest on it. So that is also another thing. Now, the bad side of this, the flip side of this coin, is that we also see a lot of these zombie companies that are able to survive. If you don't know what a zombie company is, then I made a video about it just a short while back, where I think I call it The Zombies Are Coming. And what that is, a zombie company, is a company that has so much debt and so little growth that they are actually just getting by. They're just making exactly enough money just to pay the interest rates. But that is quite easy if you're paying 0.5 or 1% in interest rate. But what if they didn't do any QEs and the interest rates were all of a sudden were 3 or 4%? Then many of these bad companies would simply be killed. So the flip side of this coin is, of course, that the companies might be growing due to a lower interest rate, a lower yield, but also a lot more zombie, really bad companies are being kept alive. So that is what this is telling us. Now, what this actually means is that when we are looking at the S&P 500 here, you can see, now I know this is a bit small, let me see if I can just enlarge it a bit here. Yeah, what you can see here is that we have the S&P 500 as it actually looked. And as you can see here, there were not really any QE packages. They started coming here after the financial crisis in 2008. And as you can see, this red line is how the S&P 500 should have looked. And this green-gray line here is how the S&P 500 has actually moved. So right now we are up around 3,500 in the S&P 500, but what it should have been was actually way down here around 1,800. Let's just look at that on a chart here. Let's just look at the futures here for S&P 500. What that actually means is that we should be down here somewhere instead of up around almost 4,000. And as you can see, the last time we were down around 1,800 was, let's just have a look, that was back in 16. So pretty much the stock market should only, from 2008 and up until now in 2020, should only have been up here in a bit more of a straight line, of course. But what that also tells us is that we really need to keep our eyes on the Fed, on the central banks. Of course, it's not just the Fed. That was just where the research were done. But the European market is, of course, exactly the same. But what we really need to do is we need to listen to what the Fed, the central banks are saying, because the second they start to just talk about maybe increasing the rate, the yield a bit, then we can be pretty sure that the market will tumble. There's simply no way back. I've been saying this again and again, that when we hear the Fed saying, yeah, well, the yield will be low, the interest rates will be low here for the next, let's say from 20 to 2023 or 4, as they're saying. I'm saying that is completely bogus. They cannot start raising the interest rates in 2024. The second they do it, they will simply crash the market. So there's no way back. I don't see how they can ever get a higher interest rate without a huge market crash. But as I said in the beginning, I don't know when it's coming. It could be tomorrow, it could be in 50 years. I have no way of knowing, and nobody knows that. This was, of course, the S&P 500. Let's just look at the article again, where they're saying that right now the Nasdaq 100 is up here around to 12,000, and it should actually be down around 5,000, 5,500. And let's just have a look at how that would look. Right now we have here the Nasdaq 100. We are up around just the 12,000 mark up here, and the 5,000, 5,500 is way down here. So imagine if all of a sudden the central bank said, well, we are just killing our balance sheet right now, we are doing a reverse QE, we are going back just to normal, then we could pretty much see a drop in the market like this. Of course, that won't happen. There's no way they're going to do that, because it will crush the entire economy. But this is just a very interesting article I wanted to show you, because it actually supports exactly the thing I have been saying for ages now, and that is that we are creating a false stock market, we are creating a false economy, with these low stock rates. I do actually remember an interview with Donald Trump from 2015, and he said the exact same thing. Those of you think that I always disagree with Donald Trump, that is not at all the case. I've been disagreeing somewhat with him since he became president, but in 2015 he actually said about the Obama economy and the entire US economy up until that point, the last several decades, that the lower interest rates was creating a false economy, a false stock market. He also said that a president that could not grow the economy of a country without a very low interest rate simply didn't deserve to be president. So we'll let that hang for a second to consider. So what this research is saying is that the QE, the quantitative easing, the Federal Reserve have been creating this extreme increase in the stock market we have seen over the last 10 to 12 years. There's no doubt in my mind that that is the case. And when I think about the market, when I sit down and debate a bit about with myself about where we are going from here, I look at short term and I look at long term. And short term, which is over the next month or maybe the next year, I have no problem buying stocks, but I use my technical analysis to tell me when to get in and out, because I know that the second we will see some sort of Federal Reserve saying that we want to increase the interest rates, we will see an instant drop in the market. So keep an eye out from it. I will, of course, make videos about it the second I see the Federal Reserve making some movements that I think could be dangerous. There can, of course, be 1,000 different reasons for a stock market crash. I am just saying that right now, the thing that is holding up the stock market primarily, that is the Fed. It is free money. I made the video the other day about this false GDP number that came out saying that on a year-to-year basis or annualized basis, the GDP would be up 33%. And I said, well, that is completely false and bogus, because almost the entire growth in the GDP came from Fed printing $3.3 trillion and pumping it straight out so that people could spend money and thereby increase the GDP. So the increase in GDP was simply just the Fed printing money and magically getting the GDP to grow. So that is how it is right now. The entire economy, the entire stock market is carried by the Fed. And that they might be able to do that for decades from now. From now on, I have no idea how far this can go. I am just saying the second it stops, the stock market drops. All right, that actually rhymed. That was quite nice. But anyway, that's all I wanted to tell you today. It's not to make you nervous and make you run out and sell everything. I am not selling everything. I am buying stocks right now. I have no idea if the stock market will go up or down, but I'm getting buy signals in my method, so therefore I am buying stocks. That's how it is. Take care of yourself, take care of your money out there, and I'll talk to you again very soon. Bye for now.